The US Treasury bond market has fallen by 50% since 2020, making US Treasury bonds one of the worst performing financial assets of the past few years. In fact, never in the 250-year history of the US Republic have US Treasury returns fallen 4 years in a row. That's a big deal because falling Treasury prices drive up yields, increasing borrowing costs for the government, businesses, and consumers, which could slow economic growth. So the question now is, will this trend continue, and what happens if it does? You might have heard that President Trump is completely rethinking US trade ties with the rest of the world. That's caused a lot of other countries to reevaluate their relationship with the US and reconsider whether they want to stay invested in the world's largest economy going forward. For many countries, those investments are in US Treasury bonds, long considered the world's safest investment. In fact, 33% of outstanding US debt is foreign owned, as you can see in this breakdown. The financial sector accounts for 31% of US Treasury ownership, which includes banks, mutual funds, and hedge funds. The government and households own most of the rest, at 24% and 11% respectively. This chart shows how foreign ownership of US Treasuries has changed since 2002. The biggest foreign holder of US Treasuries is Japan, which owns over $1 trillion in US Treasuries. Next is China, with over $760 billion. But now, amid fraying trade ties and fading perception of US exceptionalism, those other countries might have an incentive to sell those bonds and look elsewhere. A massive foreign sell-off like this would be devastating for bond prices. That's because the price of bonds responds to the same basic forces as any other market: supply and demand. If everybody is selling and few are buying, demand falls and supply rises. Simple as that. We've never seen something like this happen before. In fact, we can see from this chart that the foreign holding of US Treasuries has actually been on the rise the past few years. But we did see a small contraction in Q4 2024, and this doesn't include the fallout from tariffs. So in the next month or two, we might see this number begin to go down in the fallout of hefty tariffs and diplomatic tension. But foreign dumping is just the tip of the iceberg. There's more to consider here. There are growing concerns about a looming federal debt crisis, voiced by billionaire investors like Ray Dalio, that make the falling price of bonds potentially catastrophic. That's what bonds are, after all. Bonds are just debt sold to the public in order to finance the government. And the US government has been spending a lot. Here is their balance sheet going back about 30 years. You can see they've been accruing a growing deficit, meaning they spend more than they take in, and the deficit ballooned to $1.8 trillion last year. It's only set to grow, and that deficit is piling onto a massive mountain of public debt, which is now over $36 trillion. In order to pay for those deficits, the US government has been issuing unprecedented amounts of new bonds. That has increased the supply significantly, and that's what's driving this big decline in bond prices since the pandemic. But that's not all. See this chart? It shows the amount of US debt coming due. This massive spike here means that the US is facing $7 trillion in debt coming due this year in 2025. It's known as a maturity wall, and the only way the government can afford to pay for it, you guessed it, is by issuing more bonds, taking on more debt. That will only increase bond supply even more, driving down prices further. And what about demand? There's no sign that it's rising, because even though as bond prices fall, yields rise, they haven't risen enough to compensate for the rising risk of investing in US Treasuries. Here's one way to look at that: the term premium. The term premium is the extra return investors expect for locking up their money in a long-term bond, like a 10-year Treasury, instead of just holding short-term Treasury bills for the same period. It's all about the risk of tying up your cash for a decade. Historically, it's hovered around 1% to 2%, meaning investors wanted to take a little more reward for taking that chance. But from 2016 to 2024, the term premium went negative. Investors were actually giving up returns to hold long-term government bonds. Why? Well, back then, inflation was low. The Fed kept interest rates at zero, and they were buying lots of bonds through quantitative easing. This made long-term bonds feel safe and attractive, even without the extra return. Now, since October 2024, the term premium has turned positive, hitting 0.9 percentage points today. This means investors are starting to demand higher returns for long-term bonds again. This signals that bonds are seen as riskier, and investors want compensation for that. This is because inflation is still hanging around. Central banks aren't buying bonds anymore, and the US government is issuing tons of new bonds to cover deficits. If this keeps up, say the term premium rises to 1.5%, yields on 10-year bonds could rise even more. And because bond yields and prices move in opposite directions, that spells a further drop for bond prices. And that could be devastating for the economy. Why? Because higher bond yields echo across the economy. They set a benchmark for corporate bond yields, increasing the cost of borrowing for businesses and leading to slower economic growth. They also influence mortgage rates. Higher mortgage rates make housing less affordable in an already unaffordable housing market. And that higher cost of borrowing has a freezing effect on the economy. It could tip us into the recession. So going forward, keep a close eye on bond prices. At Capital.com, we'll continue to keep you updated on the bond market and the chances of a recession. Hit subscribe to stay tuned. Thanks for watching.